Okay, good afternoon to everyone. I hope you're all doing well. Um, so we're going to complete question 4.4 today, and we're going to also look at the diagram that I had shown you a minute ago. We look at the graphical illustration of your cost volume profit analysis. And then we'll also be working with the additional question that I had uploaded to VC Learn for you. It is based on the section costing. So it's a similar type of question to the one that we will be working with now. And it's just giving you an idea of a typical test type or exam type question. So let's work through this example. In the last lecture, then we said we had stopped at example 4.3, which was looking at how to calculate your break-even analysis, and it was based on firstly categorizing your costs as either fixed or variable in nature, and then once we have that, we would then take those fixed and variable costs and use them in the break-even formula for your break-even point in units as well as your break-even point in sales revenue. So we looked at all of that and the respective formulas in the previous lecture. We also looked at how to calculate something called your marginal cost and the marginal cost ratio. We looked at the marginal income and the marginal income ratio as well. And then we used all of those figures again in our calculation of your um, break-even point. So we are going to now look at this example. So question 4.4, as you can see, I have written at the top of the screen is based on the answers from question 4.2. So they said to you here that we're going to use all of the information from question 4.2. We're going to refer back to that question and you can look at that. I'll just project it on the screen very quickly. But you can look at that, which we did complete in the previous session. It's this one up here where we had been given a whole host of items. So this one at the bottom of the screen, remember they said to us that the company produces 320 tons per week. So we said 320 per week. There are 4 weeks in a month. That would mean that for the month we produce 1,280 units. And then we had completed this table where we put into the respective categories the costs of either direct material, direct labor, and manufacturing overheads. And these made up your manufacturing costs or your product costs. And then we have your non-manufacturing or non-product costs, which were your admin, your general admin, and your marketing, selling, and distribution costs. So we took each one of these and we put it into their respective categories. So you already have the answers to these. We're now just simply taking the same costs that have been mentioned here, and instead of putting it into the categories that we did at the top here, we're putting them into the categories of either fixed or variable costs. So same amount, so we're not going to calculate those amounts again. We're just going to pull the figures from there and we're going to put it into the respective category of fixed or variable. So remember, you're asking yourself the question here of, does the cost change with the level of activity? Meaning the more we produce, does this cost increase? Likewise, the less we produce, does it decrease? And that would mean it is a variable cost. Alternatively, it would be a fixed cost where the cost remains the same regardless of the number of units being produced. So here the first item was exactly the same first item under that example. It was your polyethylene that was purchased per week. So here what they were asking us to do, like I said, was to categorize the cost as being either fixed or variable in nature. And then at the top, as you can see, I have highlighted that they've said to you that this company uses a 150% markup above their variable cost. So we're going to use all that information to complete whatever was required here. So the first question is what we're doing at the moment. We're completing the table by using monthly figures. Please make note of that. Remember, these tables are based on monthly figures. And then they said to you to calculate the variable cost per ton, calculate the selling price per ton, calculate the marginal income ratio, the break-even point in units or in tons in this case, the break-even point in terms of sales revenue, and then how many units need to be sold in order to make a profit before tax of 10 million rand for the year. So here you have, and in the last question, it's just a theory question. This is saying to you outline ways in which they can reduce their variable costs. So we're going to ignore that one because you can read through that from your learning unit from the slides or your textbook itself. We'll focus on the rest of them. So the first question is, as we said, to complete this table and categorize the costs as being either fixed or variable in nature. So here we're going to just pull the figures as we said. We're not going to calculate them again. So you can go between question 4.2 and this, and I will write down the figures here for you as well, but just so you know, the answers are coming from question 4.2. So the first item was your polyethylene purchased per week. This was the direct material that was being used in the production process, and direct material is a variable cost because it is an item that will change with your level of activity. So here it's going to be 100,000 rand, because remember it was on a weekly basis that they had given you the amount, and you would then need to convert it to a monthly basis because they did say to you it was per month here. So that's the first one, your per direct material, which is variable in nature, because this is saying to you that it is going to change with your level of activity, meaning the more we produce, the more we will require, the less we produce, the less we will require. So that is your first item. Then you have your direct labor in the next question. So this is the wages of the machine operators. They said to you it was 1,200 and it was per operator per week. So you needed to account for the fact that it was per operator and there were 30 operators, and then there were 4 weeks, so you needed to also multiply by 4. So that gave you a total cost of 144,000, and it's also variable in nature because again, the more we produce, the more labor hours we will require, or the more labor force we will require. So it will increase the cost of your direct labor. So just keep asking yourself the question for each item here of whether they will change with your level of activity or whether the cost will remain the same regardless. Then you have your monthly salary of this factory supervisor. It's 13,000 rand, and here it is already on a monthly basis, so you don't have to do any sort of conversion. And the cost here is going to be fixed because this is a cost that will remain the same regardless of the number of units being produced. The factory supervisor salary does not depend on what your level of production is. So that's 13,000 here. Then the next one is your depreciation on your plastic extruding machines. It is 246,900 per machine per annum. So remember here we said that because this was per machine, we also needed to remember that in question 4.2, they said to us that there were 4 plastic extruding machines. This bit here at the bottom, 4 plastic extruding machines that the company had within the factory. So we needed to bring this into our calculation because to convert this to a monthly figure, the first thing we needed to do, and we did this in question 4.2 as well, is you multiply that figure by 4 to get to the total value of depreciation for all 4 machines. But then because it was per annum, once we had that total, we would divide it by 12. So that gave us a depreciation figure of 82,300, and depreciation does not depend on our level of production. So this would be a fixed cost. So both the depreciation items next up as well will be fixed in nature, and they're both on an annum basis, so you will divide both of them by 12. So we already did this. So that was a figure of 4,000 Rand under your fixed cost for the first one, and then 1,300 Rand under the second one. So those were your depreciation items. Please stop me if you are confused about anything or you do need me to explain again. I'm happy to do so. So then the next one was your CEO's traveling cost, and this was 5,500 Rand per month. This is already on a monthly basis, so you don't need to do any conversion. And then the CEO's traveling will have, again, no impact from the number of units being produced. This is an item that's completely independent. It is not going to depend on what the level of production is. Then you have your rates and rates and taxes as well as rent are always fixed in nature. And this is an amount of 14,000 Rand. So the entire 14,000 Rand will be allocated to a fixed cost. You don't have to worry about this bit here that they had mentioned to you within brackets about how much floor space the factory takes versus the office, because that would only be if we were putting it into the categories of direct material, direct labor, overheads, general admin, marketing, selling, and distribution. Here, we're not putting it into those categories. We are just identifying whether the total 14,000 Rand is fixed or variable in nature. Then you have advertising and distribution costs. It's 1,500 Rand per week. So we needed to multiply that by 4 for the month. And advertising and distribution costs do not depend on your level of production. So that would be a fixed cost, and it is 6,000 Rand in total. Then you have your indirect materials that are used in the production process. It is 23 Rand per ton of the item produced or manufactured. So it's 23 Rand per ton. We need to know now how many tons do we produce for the month. So we had already determined this again in question 4.2. Remember, we said it was 320 for the week. So for the month, it would be 320 times 4. And that gave us the 1,280 tons for the month. So you would then take the 23 and multiply it by 1,280, and that would give us a figure of 29,440. And here, this would be variable in nature because it is an item, it's indirect material where it's per ton manufactured. So when it's per unit, most of the time, you're going to find that it is variable in nature. So here it depends on how much we've produced. So the more we produce, the higher the indirect material cost will be because it is per unit. And the less we produce, the lower this cost will be. So that would be variable in nature. Then the next one at the top is the wages of the factory cleaning staff, and it's 3,050 per week. Again, this is needing to be on a monthly basis, so we multiply it by 4. And the wages of the cleaning staff does not impact the level of production, or it's not impacted by the level of production. So all you're going to do is convert that to a monthly basis, and it will be fixed in nature because it is the same regardless of how many units are being produced. Then you have the fees that are paid to the security guard, both the one that is positioned in the factory and then the one that is outside the main that is stationed at the main entrance of the admin building. It's both 800 Rand per month, so it's already on a monthly basis, and their salary of 800 Rand a month does not depend on the number of units being produced. It is the same regardless of production. Then you have your monthly insurance premium. It's 3,400 Rand in total. Again, you do not need to worry about the separate cost for the factory and the separate one for the office because The total of the RE4 just needs to be classified as fixed and or variable. It does not need to be broken down here. It was already broken down in question 4.2, where we looked at which category it would fall into. So here, 3,400 Rand is your total insurance premium, and this is going to naturally not be affected by your level of production. So it stays the same at 3,400 as a fixed cost. Then your import tariffs and custom duties that are paid on the polyethylene imported from abroad, it's 1,500 Rand per 100 tons imported. So remember here, firstly, we needed to convert that to a monthly basis. So we said it was 1,500 per 100 tons. So we worked out the value for just 1 ton. And then for the month, we produced 1,280 tons. So we multiplied that by the 1,280. So this gave us a value of 19,200, and it is variable in nature because this is based on the raw materials, the polyethylene that is imported. So the more we produce, the more raw materials we'll need, and the higher this import tariff or custom duties will be. And then the next one is your telephone, stationery, and general office expenses. That's 2,700 Rand already on a monthly basis. So you don't need to convert that. And then this is a cost that will stay the same. The amount of stationery we buy, for instance, is not impacted by the number of units that we sell or produce. So it's going to be a fixed cost. And the last one is railage and carriage. This is 2,200 Rand per consignment of 400 tons that are sold. So here again, we need to convert that to a monthly basis, to a single unit basis. So it's 2 per 400 tons. So the value of 1 ton is calculated by 2,200 divided by 400. And then this is multiplied by the total number of tons produced, which is 1,280 for the month. So this gives you a value of 7,040, and this is based on carriage on sale. So the more we produce, the more we sell. The less we produce, the less we sell, and that would accordingly affect our railage and carriage. So it will be variable in nature. Okay, so those are all of the items that make up our costs. Your totals then can be calculated. So you have 146,000 as your total fixed cost, and your total variable cost is 299,680. So now we are able to firstly, that was question 1 complete. Now we're able to use the figures that we have calculated and now put it into the respective formulas to calculate whatever they had asked us for. So the first question asked you for, or the second question rather, asked you to calculate the variable cost per ton manufactured. So here we had manufactured 1,280 tons for the month. So we are just now going to convert that total that we have of 299,680 into a per unit figure. So to bring it to a per unit figure, all you're going to do is say that it is the total variable cost divided by the number of the number of items produced, number of tons per month. So this is going to be 100, sorry, not 100, this is it here, 299,680. That's your total variable cost divided by, we produced 1,280 units for the month, and that would be 234.13. Okay, so that's your first answer. That is your variable cost or your marginal cost, and it is going to be used later on where we use this variable cost to calculate the break-even point and so on. So then you have in the next question, they asked you to calculate the selling price per ton sold. So the selling price is calculated using the formula of selling price is equal to your cost price multiplied by 100 plus the markup over 100. Okay, so here your cost price is the one that we just calculated in question 2. So that's 234.13 multiplied by 100 plus the markup percentage we saw on the previous page. They said to you it is 150%. So that would be 100 plus 150, which is 250 over 100. So you can just write it down as 250, but just to ensure that in case there are part marks, you are awarded that, it would be 100 plus 150. So that gives us a selling price of 585.33. So here I'm going to just write down the final answers that we calculated because I'm going to need a bit of space here just now to write this down. So I can erase this and I'll write down the final answer. So your variable cost is 234.13 and your selling price is 585.33. Then the next question said to you to calculate the marginal income ratio. That's here. Your marginal income ratio is calculated as your marginal income over your sales. So here it is, since it is, they asked it to you, well, they just said calculate the marginal ratio, but we have your figures in per unit as it stands, so we'll work it out per unit. So it's your marginal income over your selling price per unit, and here or your sales per unit, your total sales can also be your denominator. Remember, it's just depending on the information that you have been provided with. So here, I'm just erasing from the bottom. Okay, so here we have your marginal income per unit. This is calculated as your selling price minus your variable cost per unit. We saw this in the previous lecture. So your selling price per unit is 585. It is what we had done now in step 3, 585.33 minus your variable cost, which we did in question 2. That was 234.13 over 585.33. Sorry, I'm not sure why this is not allowing me to. It's duplicating over. So that was 585.33. Okay, so that can be expressed as a decimal. So that could be 0.6 or it can be 60%. So that's your marginal income ratio. Then the next one asked you to determine your break-even point in tons, which is also another way of saying in units. It's just because we were working with tons here. So break-even point in unit, remember, is your total fixed cost over your marginal income ratio, which is your selling price per unit minus your variable cost per unit. So your total fixed cost we got from the top here, it was 146,000 Rand, and then it's divided by your selling price per unit, which we also again just calculated is 585.6 sorry 0.33. So you see how important it is to make sure that you are getting your costs correct as you're filling them into the table, because one cost that is calculated incorrectly is going to have a domino effect. Because if you mistakenly had calculated the variable cost as being wrong, then you're going to find that your variable cost total itself will be incorrect. It will impact the selling price because you use the selling, or you use the variable cost to calculate the selling price. Then you have your marginal income that would be incorrect because you have the variable cost included there. Your break even in sales would be incorrect. Literally everything will be incorrect, and it will be a domino effect where the first one wrong impacts every other question. So here it would be best to read through the question carefully, identify and maybe write out even during your reading time that this is per unit versus this is a total. And hopefully that would be making it easier for you. So please make sure to pay careful attention to that. And that was your figures that go into your your break even point in tons. So this is an answer of 416 ton. Well, actually, it was 415 point. I'm just erasing this. I'll write it down just now. So it was 415.72. And for the purpose of the textbook, they are rounding up, I think it is, but for the purpose of the IIE, they prefer that you round it down. But I will suggest that you just leave it as a two decimal place answer, and then just also say that it's equivalent to 416 tons. But make sure that you're leaving this in your answer booklet, because this is where your marks come in. You would be awarded the mark for that and not the mark for the 416. So here the 415.72 tons is your break-even point in units or in tons. So please make sure to say that as well, like I did at the end here. We specified that it would be in tons. And then the next one is saying to you, determine your break-even point in terms of Rand value. So the one way you can calculate it is by taking the answer that we got here, your break-even point in your break-even in tons, your break-even point in units, and you're multiplying it by the selling price, which is 585.33. There are two methods to do it. You'll see that in your slides as well. The one method is just to take your break-even point in units and then multiply that by your multiply that by your selling price. This again will depend on the type of information you're given. So here it made it easy because we had all of the figures necessary to use that formula, and that should give you a value of 243,333.33. Alternatively, the second method is to take your total fixed cost, which is 146,000 Rand here, and divide it by your marginal income ratio. Your marginal income ratio we had calculated in question 4 here is 0.60 or 60%. So that gives you then the same value it should give you of 243,333 33. Okay, so either one of those formulas can be used, whichever you prefer. So please make note of both of them though, because they both can be used to calculate your figure. Okay, so that's the second last one. The last one now says to you, how many units needs to be sold in order to make a net profit before tax of 10 million rand per annum? So here it's important to note that is per annum. And remember we said when we looked at the last bit of learning unit 3, learning unit 4 in Monday's lecture, the last thing we literally the last thing is how to work out when a certain profit target is aimed at. How do we determine the number of units that needs to be produced? So we said that what you would do is you would simply take the same break-even formula that you have here at the bottom, and you're going to now the only difference is to the numerator, you are going to add on the profit target that the business hopes to achieve. So here, let me just show you the amended formula. To this numerator, you are simply going to add on the profit target. So it's your break-even formula, but you are changing so here, sorry, just giving it a bit more space. So it's the same as your break-even formula. All you're doing is to the numerator, you're adding on the target profit, and that would tell you how many units needs to be produced for the year. Remember, they said per annum in order for the company to make that profit of 10 million rand, million rand before tax. Now, what's important to note is that this was per annum, so you needed to make sure that everything is on the same unit of measurement. Now here, for the numerator, it is a total fixed cost plus the profit. The profit is on an annual basis, which we saw here, but this fixed cost is per month. So we needed to multiply that by 12 to get to the total fixed cost for the year. And then both that amount and the 10 million rand will be on a yearly basis. So then you have both of them as the same unit of measurement. So please make sure to note that they both need to be in the same unit of measurement. So here, net profit before tax was already on an annual basis. All we did was we took the fixed cost and we also converted that to a yearly basis. So we multiplied it by 12. The other way you could do it is, since you have the profit as a yearly basis, you could also convert the 10 million to a monthly figure. So it's 10 million for the year. That would mean for for 1 month it would be 833,000. So divided by 12, 833,333.33. So this would have been on a monthly basis, and then you wouldn't have needed to convert this by multiplying by 12. All you would do then is, since you converted the profit into a monthly figure, then it is going to be minus 833.33, sorry, not minus, plus 33.33, and then you'll divide by the denominator. So either way is fine. Either way, you'll end up with the same answer. So you can do whichever you prefer. If you want to work with it as is on a monthly basis, as is on a annual basis, because the profit was given to you on an annual basis already, then make sure that you convert the fixed cost into a monthly basis. Or if you want to just work with on a monthly basis, then Here, the alternative is, sorry, I need some space. So the one way, as we said, is you will convert the 146 from a month to a year figure by multiplying it by 12, and then you'll add on the 10 million. So the 10 million remain the same. You only converted the fixed cost to a yearly figure, and then it was over the 585.33 minus your variable cost, which was 234.13. Or you could do it the other way around, where you leave the fixed cost as its monthly figure and you converted the 10 million into a monthly figure. So 10 million divided by 12 brought it to a monthly figure, which was at 833,333.33, and then it's over the same denominator. So both of them will give you the same answer, and your final answer here is 462.41, and that's equivalent to 33,463. Okay, so the examples within the textbook, as I said, will be rounded up, but for the purpose of your test and exams, please round down because your memos have them as rounded down. Okay, so this is question 4.4. Are there any questions here? Okay, so you guys can have a break, and when you get back, we will look at the diagram. I'll explain to you how this is drawn up, and then we'll do that additional example as well. Okay, let's get started again. So, example 4.4 is a graphical illustration of our CVP analysis. So, it's basically saying that whatever we've looked at so far in terms of your costs, remember we looked at your marginal cost, the marginal cost ratio, the marginal income, and the respective marginal income ratio, and then we did um, your break-even point in units as well as in rand or sales revenue. That all can be illustrated on the respective graph, the one that you'll see up on the screen. And this isn't something that comes up often in terms of you being asked to draw it up, just simply because it can be quite time consuming to draw up this type of diagram. So it isn't something that is generally asked for you to draw up in a test type question, but it is possible that maybe in the exam they would give you maybe just part of it to draw up, but it really hasn't been something that has come up ever. So maybe in the past 5 to 10 years, we haven't seen in any of the past papers, but you never know, it might possibly come out. So this is why I'd like to just go through it with you nonetheless, just to ensure that you do know how to draw it up. And then the alternative is instead of asking you to draw it up, they could also potentially draw it up for you and then ask you questions based on the diagram. So the explanation for it is on the next page of your textbook, but you can read through that on your own. I will explain it to you here using the figures on the graph and so on. So this is looking at the same information based on question 4.4 that we just completed now. So we had just calculated that our total fixed cost was 146,000 Rand. Our selling price per unit was 585.33, and the variable cost per unit was 234.13. And then we also had calculated your break even point, which is in this little box here. We determined already that in terms of break even point in units, it was 415.72, and then in terms of rand value, it was 243,333.38. So this is everything that came from question 4.4, but now we're looking at it graphically. So we're looking at how does it fall onto these graphs. So the first thing we're going to make note of is what goes onto your X and Y axis here, and that would be the price in rand or the quantity, sorry, or the rand value in your on your y-axis, and then the quantity is on your x-axis. And as you can see, they're going in 100s on your x-axis in terms of quantity. On your y-axis, we're going in increments of 50,000. So then we're looking at plotting first your fixed cost curve. So your total fixed cost was 146,000 Rand. This is remember the same, remaining the same regardless of the number of units being produced. So it is going to be a horizontal line, which you would then have seen here as the line running across at 146,000 Rand. It's just below the 150,000 Rand mark, and it's a horizontal line because regardless of how many units are being produced here, that cost will remain the same. So that's pretty simple and straightforward in terms of your total fixed cost, and that was 146,000 Rand. Then we have the next one, your variable cost curve. So with your variable cost curve, the first thing that we need to note is that it will always start at the origin. So you have one set of intervals or one set of values that you can use to plot down that graph. This is because if we're producing 0 units, then there is no variable cost. So at a zero level of production, the total cost as well will also be zero. So this is why it starts at your origin. And then you will need to plot one other set of values on the graph so that you can draw out that line. So here, as you can see, they've used point C, where the production level is 500 units. And so to get to what the respective value is on your y-axis, in order for you to be able to have even got to point C, we would have said if 500 units are being produced and we are working out the variable cost, then we know the number of units is 500, but what's the respective value in terms of rands? So then we would say that the variable cost is 234.13 per unit, but we are now looking at for 500 units, so we multiply that by 500. So that gives us a total cost of 117,065. And so now we would go to the diagram and we would plot 500 units here at the bottom in line with 117 somewhere here, 117,065. That's just above the 100,000 mark. And in line with that, going across here, and in line with the 500,000 coming down here, you now have plot point C, and you can plot that line then by drawing drawing a line through both of those dots, both of those points. Okay, so that was your variable cost curve. Then for your next one, which is your total cost curve. Now we're going to look at your total cost and what makes up the total cost. So your total cost curve, which is the one that you see up here, your total cost is made up of the sum of your total fixed cost. We saw this in the previous lecture, plus your total variable cost. Now, let's use point B here because this is the same, it's in the same line as point C. So we know that we can use the 500 units. So what we're going to do is we're going to say that when we calculated at point C, the total variable cost, that was 500 units at 234.13 each, that gave us a total variable cost of 117,065. Level the same 500 units at 234.13, and that'll give us the 117,065. And then for the total fixed cost, this came from here, 146,000. So we'll still use 500 units as our number of units, but now when we calculate this, 146,000 plus the 117,065, that gives us a total cost of 263,065. So now we will plot at the 500 units coming down here, and then at the respective cost of 263,000, which will be just above the 250,000 mark. That is then your 263,065. And then that's how we got to the 2 points for your total cost curve. It would have been the origin, which is the total fixed cost. Well, remember, your total cost is made up of the fixed cost plus the variable component. So it must start at the same level that your fixed cost curve starts at, which is the 146,000, and then it's going to increase through point B to give you your total cost curve. So that is your total cost curve. And then the last one is your total revenue curve. So your total revenue curve is also the same type of idea as we had seen with your total cost curve. The total revenue will start at the origin, sorry, your total, it's the same as your total variable, where it starts at the origin of zero. This is because when we're producing zero items, that means we're selling off zero items, which means we're not making any revenue or sale. So it will start at the origin of zero, and then you can go through any other point. So let's look at maybe here. This is approximately 600 units. As you can see, if we go down to the bottom here, so if we're taking this down to the bottom, this is at approximately 600 units. So then we're going to say 600 units is what our items sold are, and we want to know what's the total sale. Then we're going to take that and multiply it by the sale price per unit, which is 585.33. So this would be a total value of 351,198. So now we would go 351,098 would be just above here. So you can see that on the graph as well. When we go all the way across here to that point, and then you will then draw out your straight line joining those points. So through, you have one other point on the graph, so that's the one we had determined here, and the origin. So it made it possible for you to just draw a line through those 2 points. Okay, so that's how you drew up the curves, your variable cost curve, your fixed cost curve, your total cost curve, and then the total revenue curve. And then you then would locate your break-even point where the total revenue curve is intersecting your total cost curve. So I'm just going to write that out for you here, where your total revenue is equal to your total cost, and that is here. This is your total revenue curve. This is your total cost curve. Where they intersect is point E here. This is your break-even point. And at this point, you're going to see that if you go down to your x-axis, that gives you approximately just after 400 your units of your break even, which is the 415.72. And then in terms of rand value, you then had a value of the 243,333.38, which is just below the 250,000 mark. And that would have been your break-even point. Okay, so that's what your break-even and your CVP analysis looks like graphically on a diagram that is illustrating all four of those cost curves: your fixed cost, variable cost, your total cost curve, as well as your total revenue curve. Any questions in terms of the diagram? So the explanation for it is also on the next slide and also on the next page of your textbook. So you can read through that as well. And it's pretty much exactly the same type of thing that I had explained to you. This question 4.6, I'm going to give you a minute to take down the answers of. It is just identifying all the different types of costs that can come up and looking at what category it would fall into, meaning will it be fixed or variable in nature, and then also would it be non-manufacturing or manufacturing in nature. So please take down the answers of these. I'll give you a minute. Okay, then also on the next page, you can take these down. This is also just putting the costs into the relevant categories of either being variable or fixed in nature, and then direct or indirect in nature. So I'll give you a minute for this as well. Okay, so on the next page, question 4.7 in your textbook, please can I ask that you attempt this on your own? Don't worry about the third part of the question. So just question 1 and 2 here. Please attempt these on your own, and I will go through the solutions of that in your next lecture. But for now, I am going to work with that additional example for Learning Unit 4. It's just basically revision of the learning unit. Just a quick example to reiterate everything we've seen so far. And it is from a past paper, as I said. So it really is an extremely useful indicator of what they could get or how they could test you. So let's go through that. And then please, as I said, do complete question 4.7. So I have uploaded this. It's under the case studies folder on VC Learn, and you can access it there. It is looking at the same type of question that we just worked with in question 4.1 in your textbook, where they've listed out a whole host of costs for you, and you are going to categorize them because they've said to you here under what was required is that they wanted you to calculate the variable cost per iPhone cover manufactured. That was for 12 marks. Then they asked you, this was a theory question, they asked you what a sunk cost is. Then they asked you to calculate the fixed cost for the month for 7 marks. Then the selling price, if there was a 300% markup above the variable cost, then the marginal income ratio and the break-even point in sales revenue. So let's have a look at these questions and the respective answers. So let's identify from the information that has been provided what the costs are and whether they will be classified as either variable or fixed in nature. This then will make it easier for us when we get to the calculations on the next page. Once we know that they were variable or fixed in nature, we just put them into the relevant question and we calculate whatever they had asked us for. So the question says to you, and as you can see, it's for 30 marks, which is a hell of a lot. And in your exam, that literally, and you'll see that this type of question, and even the one we just worked with in question 4.4. It can go from anywhere to 30 to 45 marks, which ends up being quite a significant amount of your paper. Depending on the mark allocation, it can go anywhere from 1/6 of the mark of the total mark of your paper, or it can be basically a quarter of the marks of your paper. So if it's about 45 marks, that's literally 1/4 of the paper. So remember, your exam is 180 marks. So that would be exactly 1/4 of your paper, which is quite significant because in one question, you're literally taking care of 45 marks of your exam. So this is an easier section as well, and it is obviously one where you can score big in, but at the same time, it's also one that can go quite wrong quite easily. And what I mean by this is, like in question 4.4, where we had to calculate the fixed and variable cost first, and then use that to calculate your marginal cost ratio, your marginal income, your selling price, your break even in units, and so on. If you're getting something wrong right at the very beginning in your calculation of maybe the fixed cost or the calculation of your variable cost, it really has quite a domino effect. Get that wrong, then your totals of your fixed and variable cost are wrong. And then you use your selling price, your variable cost, your marginal income, your marginal cost, your break-even point, and literally everything goes wrong after that. So it's very important that you do pay careful attention to it, because at the same time, even though it is an easier section, it also is quite easy to go wrong with some of the figures along the way. So make sure that you read in detail every single bit of information and you convert where necessary, because it can have quite a detrimental effect if you're getting any of those figures incorrect. Okay, so back to the question, they said to you, Cover Up Limited manufactures cell phone covers in a factory in the Western Cape. Management are introducing a new range of cell phone covers for the iPhone 8, and they are seeking your advice on the costing of the covers and have provided you with the following information. So in the first point, they said to you, all of the iPhone covers are exactly the same. And then in the second point, they said to you that production is 1,500 units per month. So please make note of that. Then the next one says each cover requires 50 grams of plastic, the cost of which is 400 rand per kg. So the first thing is that this will be a variable cost because this is your raw material being used. So I'm going to indicate the letter V for variable or F for fixed cost next to it on the left. And this will help us when we are putting it into the relevant questions. And then in terms of the calculation of it, they said to you each cover requires 50 grams, but in terms of the costing, it was 400 rand per kilogram. And then they said to you within brackets that 1000 grams makes up 1 kilogram. So please make sure, and this is where I was saying to you in terms of the conversion, that you do remember that you need to ensure that it's all on one unit of measurement. So here, where it was 400 rand per kilogram, they said to you within brackets, it is 1000 grams that make up a kg. So to work out the cost, you are going to say that, and remember they asked you for variable costs per unit. So all of these need to be on a unit basis, a per unit basis. So it is 400 rand for 1000 grams. And this is going to tell you the cost of 1 gram. So cost per gram. And then you require 50 grams for 1 unit. So you will multiply that by 50. And that will tell you the cost of your material per unit. And that is 20 rand. Then for the next one, please stop me along the way if you're confused about anything. Then the next one is each cover requires 10 minutes of a factory worker's time. This is your direct labor, and direct labor, remember, is variable in nature as well, because the more we produce, the more labor hours we'll need, or the more we'll need to employ. So each cover requires 10 minutes of a factory worker's time. The factory workers earn 75 rand per hour. So remember now again, it needs to be on the same unit of measurement. So the first thing they said to you was that they required 10 minutes per item. Then they said that the cost is 75 rand per hour. So you need to make sure that you convert them such that they are both on the basis of either minutes or hours. The easier way is to just convert to minutes. So the first part is we need to determine that if it's 75 rand per hour, that's 60 minutes in 1 hour. So this is the cost per minute. And then in total, we require 10 minutes to produce one cover. So multiply that by 10. And that tells us then that the total labor cost per iPhone cover per unit is 12 rand 50. Okay, then the next item says once a cover is produced, a label is stuck to the cover which reads, "This iPhone 8 belongs to dot dot dot." Labels are purchased in boxes of 100 that cost 50 rand per box. Now, all you need to know is what is the cost of one label. So that is going to be 50 rand in total divided by 100 labels. This is because we are working out the cost of one unit. Remember, this is what the actual question had said. They said to you, determine the variable cost per unit, not the variable cost for all the units. Then you would have worked out it for all 1,500 units, but that's not what they're asking you for. They want it per cover manufactured. So you just needed to then work out the cost for one item. So this was going to be then a value of 0.5 or 50 cents. Okay, then this is also variable in nature because it depends on how many iPhone covers are being produced. The more we produce, the more labels we will need, and the less we produce, the less we will need. So this is going to be a variable cost. Then you have glue that is used to stick the labels onto the cover. This is also variable because the more we produce, the more glue we will need. So that will be variable as well. And a tube of glue costs 60 Rand and can be used for 80 labels. So again, here we just need to know the value for one iPhone cover. So one label goes onto one cover, and one label, they said to you 60 Rand would be for 80 labels, to stick 80 labels. So for one label being stuck, it's going to be 60 divided by 8, which is 0.75. Then you have the factory supervisor went to China for an expo on iPhone 8 covers, where 40% of his time was spent researching the iPhone 8 cost 15,000 Rand in total. Now, here, what's important to note is that firstly, the cost of this trip because it's not going to depend on how many units were being produced. The second thing is, remember, and we went through this in Learning Unit 4, we said that these costs are always job specific, meaning that it's only going to be the cost relevant to this job being carried out. If it's not specific to the job, it is not included. So here they said to you it was 15,000 Rand in total, but only 40% of his time was spent researching the iPhone 8 covers. So we are only then concerned with the 40%, because the other 60% was researching other stuff, and that is not relevant to the job at hand, so it cannot be included. So that would be 6,000 Rand as your cost here. Then the next one is the factory supervisor's salary. He earns 17,000 Rand a month. But again, here it's estimated that he will spend 15% of his time each day supervising the manufacturing of the iPhone cover. So again, we're not concerned with the entire 17,000 Rand. It's only the percentage of his day that is spent on the iPhone covers itself. The remainder of the amount is not going to be applicable to this item being produced. So this would then be 2,550 Rand. And this is also fixed in nature because the factory supervisor's salary is not going to be affected by how many units are being produced. The next one is the quality controller. 12,000 Rand per month is what he earns, but he again will only spend 8% of his time ensuring that the covers fit the iPhone perfectly and are free of defects. So it's the 12,000 Rand multiplied by only the 8% applicable to the job at hand, and that would be 960 Rand. This is also fixed in nature because the quality controller is not, his salary is not affected by how many units are being produced. So always just ask yourself that question. Is the item going to be dependent on the number of units being produced, or is it the same regardless of how many units are being produced? And then the next one is your rent. It's 15,000 Rand a month, and rent is always fixed in nature. But they said to you, in terms of the rent, 85% of the total area makes up your factory, and of the factory space, 10% is for the iPhone 8 covers. So again, it's not the entire 15,000 Rand. We first need to work out the space that the factory takes up and what the relevant rent will be. And then in the factory, only 10% of the space is used up for the the iPhone 8 covers. So this again then would need to be only specific to the job at hand, and that is 1,275. And then the last one is your electricity within the factory. And this is, they said to you, 6,000 Rand a month without the manufacturing of the iPhone 8. Assume that the factory operates at full capacity. Electricity is 6%, is increasing by 6% when the iPhone 8 cover commences. And then the electricity is a variable cost. They said that to you here. So we're not concerned with the entire 6,000. They said to you that it increases by 6%. So we're only concerned with the 6% increase. And because it's a variable cost and we're working it out per cover manufactured, whatever the electricity cost is, it's on a monthly basis as it stands. So to bring it to a per unit basis, we need to divide it by however many units are being produced. And there are 1,500 units being produced, so we will divide that by 1,500. And that would give you a variable cost for electricity of 0.24 per unit. So now we have all of the costs calculated. We also know what category they fall into. So we are now able to calculate the questions that they had asked you for. So under the assumptions, they just said to you there's no wastage and no new machinery is required. Depreciation is considered negligible, so we don't need to include it. So for question 1, where they said to you to calculate the variable cost per iPhone cover manufactured, assuming that the company is operating at full capacity, you're simply going to add up all of the costs that we had identified would be variable in nature. This is per unit, so we just simply take the 20 because it's already on a per unit basis. That's for your material. Then your labor is 12 Rand 50. So that was the 20 Rand for your material plus the 12 Rand 50 for your labor. And what I would suggest is when you're answering this type of question, maybe just stick to doing it in a table format. So you could say direct material is 20, direct labor is 12 Rand 50, because we naturally need to be able to show that these were the relevant costs. So just saying 20 and 12 Rand 50 is not telling you which cost it actually was. So just putting it into a little table will make it easier. You actually don't even have to put it into a table. If you look at how I'm writing it out here, it's quite conformed and it looks neat and you can see what the respective figure is. So you can even do that. Then the next one was the labels that you required. This would fall under the category of indirect materials. So you can either write it as indirect materials or you can just say label. That's fine as well. And maybe on the side, you can say that that was your indirect material. This was 0.5 per unit. And then your glue in the next one was 0.75. So you would say then glue, and I was saying to you on the side, you can show that it was an indirect material. So maybe you can just do that and say that this was your indirect material. So that was the two of those. So those were all the variable costs on this page. And then the last one was this electricity here. So you would then say that this would be electricity that you're paying for, and that's 0.24. So when you add that up, that gives you a total variable cost of 33.99. So that would be here, 33.99. Okay, so it looks pretty neat, pretty presentable at the bottom. So you can do it in this way, and it makes it easier. We can see exactly where the cost was allocated, where it came from, and you have converted them to a per unit basis. Also, when you are doing this in a test, make sure, remember, you have to show your working out. So this would, for instance, here, where we calculated direct material, and then we did your direct labor here, and your labels were here, and your glue was here. Just maybe when you're drawing up your table or you're writing it out as we did here, you can maybe within brackets here just leave a bit of space and show the working out for each one and then the respective value. Okay, so that was your variable cost. The next question asks you to explain the term sunk cost. And then from the information provided above, meaning from the question, you're required to provide an example of a sunk cost incurred by Cover Up Limited in relation to the iPhone 8 covers. So a sunk cost is, remember, a cost where once incurred, it can never be recovered, or once you've entered into an arrangement where you have paid a certain amount or a certain cost, you cannot recover any of that amount of money. You cannot change any decision that was made at this point or in the future. So an example of a sunk cost is perhaps the rent that we had paid for the factory space, or even the factory supervisor's business trip, the 15,000 Rand, where once you've paid for the trip and once the cost of rent has been incurred, you aren't going to be able to recover any of the funds from that. And you're also not going to be able to change the rental agreement at the moment. And most of the times it's with a long-term lease. So once you enter into the agreement, it is difficult to get out of. So that is your second question. Then the third one is to calculate your fixed costs for the month. So I'm going to just erase this at the bottom here. Your fixed costs were the four of them that we had identified from the previous page. So again, you will show the working out of that, and you will say that your fixed costs, they start off with, the first one was the business trip for the manager, oh sorry, for the factory supervisor, that was here. So you will then say, and I'll just do it on this page because we do have the information here. So the first one was the factory supervisor's business trip. So you can just maybe write down exactly that, business trip. And remember, we had calculated that the amount for the business trip applicable to the specific question was the 6,000 Rand. So I'm not going to write the working out again because we already did that. So you can show the working out within brackets here. And then you have the factory supervisor's salary. So I'm just going to say supervisor salary. And again, here we worked out the amount specific to this job being carried out, and that was the 2,550. Then we had the quality controller, and the quality controller, again, only the amount specific to the job at hand, and this was the 960. And the last one was your rent, which was again also calculated depending on the amount of space that producing this item would have given us. So here it would have been the 1,275. No problem, Alex. Enjoy your long weekend, and I will see you again next week. Okay, so that was your 1,275. And then you simply would add up these four, and that would give you a total fixed cost of 10,785. So once you have that, that is your total amount here. And the next question then asked you to calculate the selling price. of the iPhone 8 cover if they are adding on a 300% markup above the variable cost. So you're going to now work out the you're going to work out the selling price per cover. So it's above the variable cost, which means we need to look at the variable cost from question one. That was 33.99. And this is calculated as, to calculate a selling price, the formula, I'm writing it at the top, is to take the cost price and multiply it. We saw it in example in question 4.4, multiplied by 100 plus the markup over 100. So here it is multiplied by 100 plus the 300 in your numerator, so that's 400 in your numerator, and then it's over 100. So this is going to give you a selling price of 135.96 as your selling price. And then in the next question, they asked you to calculate the marginal income ratio for each iPhone cover manufactured. So your marginal income ratio is calculated as your marginal income per unit, because it is per unit here that they asked you for. So marginal income per unit divided by your selling price per unit. So your marginal income per unit is calculated as the selling price minus your variable cost per unit. So here your selling price per unit is the 135.96 that we just calculated, minus your variable cost per unit in question one was 96, not 99. So 0.9. Sorry, I said it the wrong way. 99, not 96. And then it's over your selling price per unit, which is the 135.96. So that then gives you a marginal income ratio of, either as a decimal, it would be 0.75, or it would be 75%. And then your last question is to calculate your break-even point in sales revenue. So there's two ways that you can calculate that. Remember, the first way is to take your break-even point in units and multiply it by the selling price. But here we didn't calculate the break-even point in units, so we're going to use the second formula. That is the total fixed cost over your marginal income ratio. So your marginal income ratio was already calculated in question 4.5, the one we just did now. So that denominator will be 0.75. And your total fixed cost, which is your numerator, we calculated on the previous page here, is 10,785. So that will be your your numerator. So this gives you an amount of 14,380 as your break even in sales revenue. Okay, so that is it for this example and for learning unit 4 as a whole. Are there any questions from you? Okay, so that will be it for today. When I see you again next week, we will be starting with Learn Unit 5. Enjoy the rest of your day and your weekend as well. And I will see you again next week. Bye, everyone.